Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hi, everyone. Welcome back to our weekly podcast, Through the Noise. My name is Hannah, Portfolio Strategist with the Standard CIO office, and I will be your host for today. So joining me today is Rajat, our Senior Investment Strategist, to help unpack market events and talk about positioning and where opportunities might lie next. So hi Rajat, we're going to jump straight into it. I think first thing on our investors' minds is the Middle East tensions. We've seen that it has escalated again, and this comes at a time when we're about to enter the earnings season in the US. So how worried should investors be?
Hi, Hannah. It's great to be back here. Indeed, as you mentioned, President Trump is declaring the end of the ceasefire and the resumption of hostilities have revived concerns amongst investors. However, I should say that the upcoming US Q2 earnings season is likely to reinforce two factors that have driven global equities to record highs this year, despite a once in a generation oil shock. First, the strong upswing in tech sector earnings, driven by soaring demand from the build out of the AI related ecosystem. Second, the broadening of earnings growth beyond the tech sector. These two drivers are likely to continue, in my mind, to help overcome any intermittent escalation in Middle East tensions that you refer to. We expect the global tech sector to actually beat earnings expectations, allaying concerns about capital investment and AI monetization. This creates an opportunity for those underinvested in the sector to add exposure ahead of the earnings season. Meanwhile, broadening of earnings should benefit our preferred equity markets in Asia and Japan, particularly in China. In fixed income, we see an opportunity to add to US inflation protected bonds given attractive real yields.
All right, so maybe let's just stay on this topic for a little bit, talking briefly about the Middle East escalation. Do you expect it to be prolonged, and what does that mean for oil prices?
We actually see the flare up in Middle East tensions as a controlled escalation aimed at domestic audiences, both in the US and Iran. While Iran seeks to keep oil prices elevated by controlling the Hormuz Strait to maintain pressure on the US, President Trump is likely to be constrained by the need to keep oil prices low or subdued at least before the November's midterm elections. We have seen a spike in oil supply in recent weeks, which should help, but one thing to watch will be the willingness of tankers to re enter the strait. We see US oil trading in the $70 to $90 per barrel range in the near term. The main risk, of course, is a re escalation of the US after, actually, I should say, the US midterm elections. Although we believe the likelihood of a divided Congress after the elections, with Democrats likely controlling the House, is likely to restrain foreign military actions.
All right, and I think this week something else of interest. We also got the minutes from the Fed's June meeting. It's the first under Chair Walsh. So, what are the key takeaways from the minutes?
Yes, the minutes showed Fed policymakers remain divided on the rates path. While hawkish members, of course, focused on the elevated and sticky inflation, the sharp drop in oil prices since April's peak should help US inflation, in my mind, gradually ease towards the Fed's 2% target over the coming quarters. Now, next week's US inflation report for June should show inflation peaked in the second quarter. This should enable Walsh to convince fellow policymakers to hold rates for the rest of the year, at least until his five task forces that he just set up and announced, which are looking at various aspects of Fed decision making and communications, submit their reports. They are likely to submit the reports by the end of the year, actually. So we see value, meanwhile, in the US inflation protected bonds. Inflation expectations have fallen sharply in the US since May, close to the bottom of their 4 year range. Meanwhile, real yields in the US are near their highest since 2008.
All right, maybe let's move on to another major driver of markets so far this year. We've touched on it just now on the US corporate earnings. So, what are the expectations from the upcoming earnings season?
Yes, although geopolitical risks that we talked about warrant monitoring, you're right that the upcoming earnings season is likely to be the key driver of markets in the next few weeks. Now, sentiment should recover as US corporate earnings remain strong, with S&P 500 profits estimated to have risen around 24% in the second quarter, and they're expected to actually rise more than 20% year on year through the rest of 2026 before easing to a healthy mid-teen space in 2027. The tech sector remains, of course, the main growth engine, but earnings resilience is broadening. Excluding tech, S&P 500 earnings are still expected to grow in double digits, with earnings visibility strongest in our two preferred markets, the US and Asia Japan. Investors can use volatility to add quality exposure. Now, we continue to favor the US communication services sector, besides the tech sector, of course, and actually see tactical upside in global tech as risk reward improves there. However, we are also increasingly focused on broadening our portfolio exposure, adding more defensive elements amidst these geopolitical tensions that come time to time. In this environment, we maintain a preference for high dividend equities, which can enhance diversification and reduce concentration risks.
So, on that note, do you see any tactical opportunities in the run up to the earnings season?
Yes, we do actually. We see investors who are underexposed to global tech sector. They have an opportunity to use the recent correction to add some exposure ahead of the earnings season. As guidance, the global tech sector now represents more than 40% of global equities and indirectly around 21% of multi asset strategies, such as our balanced foundation portfolio. Specifically, our equity strategy colleagues are taking the following actions. First, increase semiconductor exposure in global tech to 35 to 40% from 30 to 35% earlier, in internet to around 30%, and in hardware and software to 10 to 15% each, while services and others are allocated around 5%. Within semiconductors, we would increase our allocation in the beaten down memory segment, where we see a short term bottom emerging due to long term agreements providing strong earning support in the coming years. Valuations have never been a concern for us, but we now see news flow momentum turning positive again.
All right, thanks, Rajat. Just as a final question, do you think the record bond issuance by the tech sector hyperscalers does that pose a broader credit market risk?
Yeah, we got this question from many clients. Our view is that the record bond issuance by tech hyperscalers are a sector specific technical headwind rather than a threat to the broader credit market. The scale of the bond issuance is significant, I must say. Five big tech giants have issued a total of around $160 billion of bonds in just 5 months, reflecting the funding needs of the AI capex cycle. Now, the surge in bond supply has contributed to the underperformance of technology sector bonds relative to the broader US dollar investment grade bond index, with spreads now the widest in a decade. However, we view this as a technical repricing rather than a deterioration in credit fundamentals. As we know, most of these issuers maintain strong credit profiles with substantial liquidity, robust cash reserves, and resilient earnings. For the broader credit market, the impact should remain manageable, in my view, given the depth of the US investment grade market. We remain neutral on developed market investment grade corporate bonds, preferring to hold them as a core allocation within our portfolio. Within tech sector corporate bonds, we prefer to stay selective, favoring the stronger balance sheets and stronger and shorter maturities. For investors seeking AI related upside, we favor the US tech equities, as we discussed earlier, where the participation in long term earnings growth is more direct.
Thank you, Rajat. Thanks for your time and your insights. I think in today's session we did cover quite a bit. We've discussed how investors can navigate the renewed geopolitical tensions in the Middle East, as well as the US Q2 earnings season, how that might be played out. So we've also highlighted, some tactical opportunities in the current market environment, including areas where investors may consider to add exposure. So that brings us to the end of today's episode of Through the Noise. Thank you again, Rajat, for joining us today. And thank you to all our listeners for listening in as well. So we do look forward to having you join us again next week.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.